Okay, grandma died, now what? Okay, what do we do? Where do we go? What do we have? I don't know. So the family starts panicking because they can't figure these things out. The population is getting older. The baby boomers are now starting to die off. They're hitting that statistical level of over 76 years old in the United States. What happens? What happens to the house? What happens to the bank accounts? What happens to all of the other assets? Today we're going to just give a short little recap of some of the topics that have come to me as a tax preparer in the state of New York, and just to mainly get yourself thinking to realize that there's more than just that annual income tax to deal with.
Good day, my name is David Fusco, and in this show I'm going to talk about business, finance, and how to survive and thrive in this crazy environment that we're living in today. Welcome to my show.
My name is David Fusco. I'm a certified public accountant in New York City, and I also have an office in the state of Pennsylvania. And the topic today is estates. And why I want to talk about that is I prepare the tax return of about 1,100 individual clients, most of which are married couples. So let's just call it 2,000 people, husband and wife, and then you got grandparents. So now you're going up to 8,000 lives, give or take. And what I've been getting a lot more phone calls over the years since I've started, people asking, my clients asking about estate tax laws and how things work. They have a parent or an uncle or an aunt or somebody in their family who's passing away or has passed away. Any planning for an estate has to be done, obviously, predominantly, I should say, prior to somebody passing away. And with the baby boomers being born starting in 1946, and depending on where you want to get your information from, ending in 1964, the baby boomer generation now is just at the edge of hitting 80 years old. Life expectancy for a person born in 1946 is around 77 years old. So it's becoming more and more prevalent, and a lot of times people don't necessarily organize and set up their estates all that efficiently. You know, some people don't care. Some people don't have the assets. But in today's world, if somebody owns a house, depending on where you're located, for example, in New York, a small bungalow kind of house could be $500,000. Standard house is probably $800,000–900,000 now. So the numbers are getting up there. Now, an off part of this topic, which I did a interview-style podcast on, was Medicaid law or elder law planning. If you want, please go back and refer to that to get an idea from an elder law attorney what you might want to do to protect the assets from Medicaid. Medicaid is where you protect the assets of the elder person from the government coming in and taking the assets post-death. And this way the assets pass to the family. But if you're lucky and you don't end up in a nursing home and it's just time to go, when you go, there are different things you can do ahead of time. Some of them are simple, some of them are not. One of the simplest things you can do, and one of the biggest mistakes I've seen is when a person does not name an actual beneficiary inside of their IRAs or pensions or 401k plans. The problem there is now it gets paid to the estate, and estates do not have the ability to roll that asset over and transfer it into their own name in an IRA form and avoid current taxation on it. So if somebody's built up $1 million over their lifetime in a pension or an IRA, that means a lump sum tax on $1 million at the estate tax level. Of course, you can pass it through, but you're no longer able to do an estate, do a rollover of that. Under the older laws, when you inherited an IRA, you could stretch it over the remainder of your own life if that was longer. Now it's limited to 10 years. But still, dividing that number by 10 years is going to be taxed at a much lower rate. You got to remember, when things hit you at the individual tax level, so let's say you're already at the 25% level, just to use that as a number, you throw anything on top, it's building off of that 25% level, and it's going to get higher and higher, up to maybe 39.6 now. And with the current estate tax laws sunsetting in another year or so, it could be even much more than that. and chances are probably will be. So that's probably the key thing is how to name beneficiaries. If you have life insurance should, again, name a beneficiary and not be payable to your estate. Now, life insurance in general is not taxable for income taxes. Why I say in general depends on if it's owned by a business. But that said, for the most part, it's not taxable for income tax purposes. But in our tax system, we have two taxes, in a sense. There are more than that, but two that affect most individuals. One is the income tax, which most working people understand that one. Every year they get to April 15th, and prior to that date, they got to file a tax form, and either they're going to owe some money or they're going to get a bit of a refund. And then there's the unified estate and gift taxes, and that's an asset-based tax based on the accumulated value that you've earned and accumulated over your lifetime, minus any taxable gifts that you've made during your lifetime, or should I say gifts that you excluded from the tax laws. We're not going to get into the details of that. It's not necessary for what I'm talking about. It's just this is more to get you familiar with some of the terminology and to maybe get you thinking. Like I said, the population is getting older, and these issues are becoming more and more prevalent, and I've noticed that in my own practice. Early in my work time, when I was in my 30s, when I started out on my own, I noticed that, not that much came in because my clients were, older than me, but not much. Now that I'm in the older age levels, I have clients in their 70s, 80s, 90s. Some actually, I think, tapping 100. So they're starting to fall off. Some of the other things that you need to consider is when you inherit an asset, and it's a balance between getting what's called an uptick in the market value of the asset versus protecting the asset from Medicaid purposes. And there's a way to get both out of them. Now, some people think the best, mom and dad's got a house. So let's say dad's gone already. Mom has a house. It's worth $1 million. And she bought it for $10,000. Just make a number up. And she passes away. If the house was in her name, it now gets brought up to the market value of $1 million. You sell that house the next day or within 9 months or year, whatever. And that's pretty much the market value date of death. And you're going to pay zero income taxes. If the house was transferred over to you prior to that as an outright gift and you received it, when you receive a gift, your basis in the asset is the same as the basis of the person who gave it to you. So if mom bought it for $10,000 and you get it gifted to you for a value of $10,000, now she dies and you say, okay, good, I'm going to sell it now. Now you're going to have to pay capital gains tax on $990,000. And if you're in a high tax state like New York, without doing the mathematics, you're probably talking about 1/3 of that's going to go to the tax man. So that's a heck of a lot of money versus zero. Now, there are ways of mitigating that where you can put life estates in there. You can do other things like that. But this is just more to give you topics that you need to think about so that you can plan properly. Proper planning is important. Actually, most recent phone call from one of my clients is their mom's now in an assisted facility, adult facility, and because they can't live on their own. She owns 2 houses, her residence, which is half rental, and another pure rental property. Now, mom was living in New York. Now mom's being moved to the state of Rhode Island. Now you're intermixing different states and different state tax laws. And so you need to really plan things out, and it's best to plan things out prior to someone passing on, because once they pass on, now you're just stuck with whatever that setup is. And if the person ended up in a nursing home or have claims from Medicaid, you may lose some or all of that asset that would have went to your family members. So these are just some of the topics that I've seen that have been coming up within my office. Another big one is annuities. Sometimes people buy annuity contracts. And what an annuity is, it's a contract between a person in general and an insurer. And so you put in a dollar amount, and 10,000, 100,000, it doesn't matter. And it grows over time. Maybe it's grown, that 100,000 has grown to $300,000. Now that money has never been taxed. That extra $200,000 that was earned on top of that. It's tax deferred while that person is not drawing down on it. Of course, if they draw down on it, they're going to be starting to pay taxes on that $200,000 gain. Person dies owning that asset, now the person inheriting it versus a home where you get it at the uptick in the market value at the date of death, your basis is not that. Your basis is whatever the decedent's basis was. So it goes back to that $100,000 basis, and that's called income in respect to a decedent, that $200,000 gain. There may be, depending on the contract, if there was nobody named as the beneficiary, again, the same problem you're going to have with the IRAs and 401ks and all that, where that $200,000 is now going to be sent to the estate of that person, and potentially is going to be taxed at a very high level. An estate, which is filed on a Form 1041, you can hit the maximum tax bracket pretty fast. I don't have it in the top of my head right now, but you're probably talking maybe $14,000 or $15,000. You're right up to the top level of federal income taxes. Versus as an individual, you need to get into the hundreds of thousands of dollars of income to get to those highest tax brackets. So proper prior planning prevents piss poor performance is an old motto that I heard from when I was my time in the Army. So do some proper planning, have conversations with your family members. Another thing is make a list of the assets. What do they have? Some people are going to be shy about telling anybody that, but hopefully they have at least one trusted member in the family. At least they should. If they don't, then go to an attorney and discuss it with the attorney so that when the person does pass on, there's a game plan and you know where these things are. So that's what I'd like to talk about today, and to get your brain thinking and to consider while we're going through the day. Oh, one more quick topic. Right now, you can have an estate of over $13 million as an individual, and there's no federal tax. In 2026, that law sunsets, and there's no set number as to what that estate tax exemption is going to be. Now, okay, 13 million is a lot, but a lesser number, obviously, is less. So I believe the thinking is it's going to drop down to 7 million. Again, that's a substantial amount of money, but it could be a lower number than that. Because it's not set in law. Maybe it's only going to be $1 million. And with one house, you could be exceeding that limit. And the estate taxes are at a very high percentage rate. So proper planning will help you get the best benefit from the person who's has the assets, the elder person. I'm sure they would prefer their family to get it versus the government. And from the person who's going to potentially receive that, of course, they would rather receive more of it so that they can have a better life for themselves and their family and the grandchildren and whatever it may be. So appreciate it and hope that's helpful. If you want and you're a client of mine, give a call. If you're not a client of mine, you can look me up and figure out where I'm at. You can give me a call also. And if not, talk to your own tax advisor, and have a great day and good luck. Thank you.